Hello traders, Gary Wagner here. Approximately 1:20 in Honolulu, 7:20 in New York. It is Wednesday, 14th day of July, 2021, and this is the daily report for gold and silver, and what a day we have seen. Chairman Jerome Powell testified in front of the Congress today, and he really tried to underscore the fact that he still believes that this high inflation rate that we have been seeing tick up, we've had the highest rate since 2008, is transitory, and that it would not be prudent to either taper or raise rates now. That is what gold traders wanted to hear, because inflation itself is a double-edged sword, because inflation alone is definitely a bullish undertone that will move gold higher. However, if the Fed acts and raises rates, that would move gold lower. And so the fact that interest is staying where it is and inflation is running hotter and hotter is the perfect storm scenario for gold to move higher. We'll talk about that. We'll talk about the resistance and support areas on the show, which begins now. Traders, today, Chairman Jerome Powell spoke before the Congress, and gold traders liked what they heard. In essence, he said that he acknowledges that interest rate is running hotter than he expected, but he thinks that acting now would be premature. They need to see substantial progress in terms of employment. That means we've got the PCE, the gauge or inflation index that the Federal Reserve uses, sitting at about 3.4. Now, their target had been 2%. They said they'd let it run around 3%, but because they believe it's transitory, they're letting it continue to run hotter and hotter. In fact, the other index, the CPI, which came out, that is at 5.4%. Last time we saw those numbers was the 2008 recession, which means we could see gold go higher. We'll talk about that on our charts because we're sitting at a crossroads in terms of where gold closed today. As I said, it is trading in Australia and currently fixed at 1828.70, putting it up 380. That is off of the close. You have to factor in New York's close, which was up $18 on the day. Traders, as you know, we were hoping for a dip to enter a long position. We have been trading sideways in the market, as you can see, over the last 6 to 7 trading days. However, today is different. It definitely tracked up much higher, but it tracked up to what we consider to be a level of resistance. Now, these levels are based on two factors. The first factor is the 200-day moving average, and you can see the high came above it, but it closed just below it. And then there is a Fibonacci retracement, and that is the 38.2% Fib retracement. That comes in at 1826. So they're both primarily at the same place. Let's assume that we get a continued breakout and a close above these two particular prices. The next level of resistance based upon the 50-day moving average, that's in green at $1,837 per ounce. I don't think that if it broke through the 200 that this would be a major level of resistance. Real resistance, I believe, would come in at approximately $1,862, and that is based upon the 23.6% Fib retracement. Remember, this retracement, simply put, is looking at the lows this year at the end of March when gold was trading at around 1673, up into these tops at around 1920. So we're only looking at this last rally. We then had a corrective period that came just below the 61.8% retracement. That made it a very valid correction, and that would mean that we are now in an uptrend and a new wave. There's absolutely no doubt in my mind about that. It's proper entry because we were trading sideways, and that to me told me that we had that breakout failure. We certainly aren't seeing it today. In fact, with the current statements of the Federal Reserve saying that they are not going to act prematurely, what they're really saying is they are going to let inflation run hotter before they do anything because their focus is on maximum employment. Now, that's interesting because we have, I think, over 9 million jobs that cannot be filled right now. We have some supply chain shortages. We have other things going on that are causing the inflationary pressure. But to get to maximum employment, we might not see that until September or after, which is when the extended and additional unemployment benefits by the government, not the states, runs out. Because that would be an incentive for those that are not working because they're making just as much sitting at home to go back and find a job. So traders, let's watch this closely, because if we do see a break above this particular price point, and it is really going to be 1826 to 1828.50, that's the differential between the 38.2% fib retracement and the 200-day moving average. The other thing that we want to note is we did get this golden cross, and that is also indicating higher pricing. So traders, it's a matter of positioning. I don't mind buying the breakout. I don't mind buying it on a dip, but I want to be on the long side if we're going to see this market run. If we're truly in a bullish scenario, we could even take out 1862 and challenge $1,920. And traders, lastly, I do want to take a look at a Japanese average chart, or Henkin Ashi, so that we can see the strength of the trend, because that is critically important. We can see at the beginning, this was our pivot candle as the market came down. You had a series of small red candles. The pivot candle is this green. The trend was not very strong, but you did have the absence of lower wicks for about 4 trading days. However, you didn't have really large-sized bodies, and large-sized bodies in a rally with strength are something like this. You then got the sideways action in which you had upper and lower wicks, which means the strength of the trend is not very strong. But today, no tail whatsoever. It really is a strong Henkin Ashi candle. You don't see it very often. If you look through all of these candles here, you will find that there are no other instances in which there is no upper or lower wick except for today. It is a rare occurrence. It's something that we want to definitely pay attention to. And I think that if we get that effective close just a couple of dollars higher on a closing basis, we're off to the races for the next leg of this rally. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.